My name is Ottaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. This is the 15th of a series of short videos dealing with subjects covered in my recent book, Climbing a High Ladder: Development in the Global Economy. In the previous video, we compared Brazil and South Korea as contrasting experience with respect to the middle-income trap. Today, we go deeper on the Brazilian case. I argue that the Brazilian economy has been suffering from a double disease in the last few decades, a combination of anemia in productivity increases and obesity of the public sector. On the one hand, the mediocre performance of productivity in Brazil in recent decades has limited its GDP growth potential. On the other, the expansion of public spending has become increasingly incompatible with such limits on the potential expansion of GDP, particularly since the growing public spending has not achieved commensurate socioeconomic results. Now, look in relative terms, the dramatic change of performance of the Brazilian economy in the last 4 decades. And as compared to the rest of the world, of course. After rising steadily until 1980, the Brazil GDP as a share of world GDP started to decline, losing relative dynamism. Well, and you can see why in absolute terms by looking at the evolution of Brazil's GDP in dollar terms. The high expansion in the first decade of the new millennium had a lot to do with the ascent phase of the latest super cycle of commodities that we approached in the previous video, accompanied by domestically a substantial incorporation of people as employed of the labor force. Since then, Brazil's economy has endured difficult years. After a deep recession in 2015-2016, GDP grew by just over % annually in 2017 to 2019. The slowest recovery on record was then hit by the 2020 coronavirus pandemic. COVID-19 significantly hit Brazil's economy, leading to a strong gross domestic product decline, around 4.1%. That was less intense, less steep than the 7.4% downfall in Latin America and the Caribbean as a whole, but a hard one nonetheless. Now, obviously, the sluggish GDP performance is reflected in the decline of GDP per capita since its peak in 2013. And indeed, the 2015 deep recession, followed by a very modest recovery afterwards, reflected the advanced stage of evolution of the double disease of productivity anemia and public sector obesity, preceded by a period of higher growth during which its symptoms were disguised by the supercycle of commodities, rising wages, and incorporation of the labor force. Let's start then with the anemic increases in productivity, that is to say, of goods and service produced in the Brazilian economy with what it has available in terms of material and human resource. Productivity, as previously approached in this series, reflects levels of efficiency in resource allocation and levels of technology use, strongly associated with human capital and intangible assets. In our video comparing Brazil and South Korea, we refer to the effects of their different educational levels of their populations. In recent decades, Brazil improved access to education, but it has way to go when it comes to quality and accumulation of human capital by large swaths of the population. In what follows, I illustrate how the lack of investments in infrastructure and an unfriendly business environment, including its foreign trade chapter, have also taken a toll on Brazilian productivity. See, this chart breaks down the contributions of demography and productivity in the Brazilian GDP growth in the decades since 1960. So since the 50s. A structural break is clear at the beginning of the 80s. The heavy industrialization period before that, happening in tandem with the shift of population occupancy that we approach in our video on the middle income trap as the stage in which productivity increased by simply shifting people from low productivity subsistence level activities to more modern activities typically happening in the cities. But this has been followed by a dismal productivity performance. Just to give an idea, more than half of per capita income growth over the past 2 decades has been brought about by increases in the share of the economically active population, which is a source of expansion that tends to decline with the ongoing aging of the Brazilian population. In this, the small performance of productivity comes clear and loud by looking at the figures on total factor productivity. That, as you may recall, reflects the increase of production that cannot be accounted for by the simple accumulation of factors of production of produced and natural assets. And from the mid 90 onwards, in fact, we watched a slow increase in the Brazilian production per employee. It rose at a snail's pace rate of only on average 0.7% a year, partly because the level of physical investment has remained low, but mainly because the overall efficiency in the use of human material resource has remained stagnant. Well, among the reasons for that, obviously, one may point out the low levels of investment to GDP in the Brazilian economy, particularly in the recent decades. Uh, so of course, Brazil's low growth rates along the four lost decades reflect low levels of investment as a ratio to GDP. You don't have to recall the exceptional and abnormal 50% rates that we saw in our video on China to realize that Brazil's investment ratios have been under what would be necessary to keep the previous evolution. And although increases of produced physical capital do not fully explain productivity and total factor productivity, low levels of physical capital do not help. And the problem of scarcity in investments is peculiar in the case of infrastructure. And indeed, Brazil is in dire need of more and better infrastructure investment. The lack of investment in infrastructure and its decline in quality in the recent past is a drag on Brazilian productivity. There has been a lack of infrastructure investment in Brazil since the 80s. While Brazil's GDP doubled in real terms between 1990 and 2016, the stock of infrastructure capacity grew by just 27%. The research by the World Bank cited in the chart pointed to infrastructure investments averaging over 5% of GDP between the 1920s and 1980s, a period in which per capita income grew at an annual rate average of 4% and urbanization reached levels of 60% in 1980. In the last 2 decades, however, the pace of investment has fallen to less than 2.5% of GDP, even below its maintenance needs. Just look at the chart. Brazil's current inventory of physical infrastructure relative to GDP is smaller than most countries with comparable income levels. Although access to electricity and telecommunication has improved since the 90s, basic sanitation and transportation networks are falling short of those of their peers, even when one considers the country's relatively high territorial dispersion and low population density. This lack of infrastructure investment has a cost in terms of poor productive performance and slower growth rates. Substantial negative effects in terms of wasted resource lost work time, misallocation of resource, product losses, etc., derived from poor infrastructure and poor energy supply and connectivity conditions in areas such as transportation, logistics, and information and communication technology. Lack of public investment has hurt potential GDP growth both directly and indirectly by discouraging private investment. And particularly low coverage in sanitation has implications for poor people. The public infrastructure spending was squeezed as current public spending grew by 2% above GDP, and primary government spending as a proportion of GDP rose from 22% in 1991 to 36% in 2014. Although public spending has stabilized since 2015 as a proportion of GDP, and since 2017 is subject to a constitutionally established absolute ceiling in real terms, the continued expansion of mandatory current spending has led to has led the fiscal space available for public infrastructure investments to continue to shrink, as we'll see in some minutes. Brazil's public sector obesity has aggravated its productivity anemia. The falling public investment has not been sufficiently offset by private investment in infrastructure, unlike in other countries in the region, such as Chile and Colombia. In addition, the public sector has remained the source of more than 70% of this financing, depending, therefore, on prevailing fiscal conditions in the country. The inevitable continuation of fiscal austerity in the near future, except for the extraordinary pandemic related extraordinary expenditures, reinforce the need for it to be accompanied by new pillars of long term financing, while reconfiguring the regulatory and operational framework to increase the participation of private investment in infrastructure. In addition to the decline in real interest rates achieved in the recent period, it will be necessary to maintain the pace of structural reforms that have gradually improved the business environment and reduced the cost of financial intermediation. On the other hand, as much as the presence of the private sector is required to expand, investment in private management in infrastructure will remain complementary to, not perfect substitute for, the public sector. In addition to the difficulties in terms of amounts of public infrastructure spending in a context of downward rigidity of other expenditure items, there is the qualitative problem of its inefficiency. It's important to improve the results from the part that will continue to be the responsibility of the public sector because the whole will depend on it. Brazilian prosperity will depend on more and better investment in infrastructure in a context of fiscal austerity. To this end, it is essential to improve the quality of public intervention and to deliver on the structural reform agenda. Now, let us remark also another dimension of inner difficulties with the Brazilian context of productivity increase, and that has to do with the business environment. Look, uh, I took this from the Doing Business report from the World Bank, and clearly, doing business in Brazil must get easier. The World Bank's annual Doing Business report compares the times and costs that a typical company in each country is forced to deal with throughout its life cycle. In the case of Brazil, recent reforms, for example, in the kind of information that is made available to creditors and in the bankruptcies law, have improved the country's position in the ranks. But there is much more to be done. Brazil needs further reform if it's to shake off its reputation as one of Latin America's most frustrating business climates. The quality of the business environment in a country is among the determinants of economic growth, as an unfavorable business environment negatively affects productivity and external competitiveness. Despite improvement, Brazil's absolute distance from the efficiency frontier, a baseline level indicating best practice in several categories, remains large, as you can see in the chart. Among the components of Brazil's business environment, the complexity and imbalance of the tax system should be a priority item for reform, as its complexity makes fulfilling even basic obligations a challenge. In this case, Brazil ranks among the worst cases in the World Bank Doing Business report. There is a strong discussion on tax reform in Brazil, but so far it has failed to have a consequence in terms of approval. Financial intermediation, the country does not provide financing on terms appropriate for investment. Brazil has taken steps to improve its credit market, but here too there is a chance for more progress. In addition to the electronic receivables registry approved in 2019, congressional approval of a positive credit registry, like a consumer credit rating system, will have a positive effect on risk assessment and bank spreads. A new bankruptcy bill has been also approved in 2019, which will complement the truncated reform that was approved back in 2005. Widening the space for greater competition in credit options for consumers, including via fintech, will also help improve access to finance. Facilitating such access on a sustainable basis and not depending on public sector favors would not only improve the business environment, but also create stronger foundations for higher economic growth. The World Bank's Doing Business report has indicated year after year how typical Brazilian companies are forced to spend human and material resource on activities that do not generate value. This subtracts from the use of productive resource in the economy as a whole. There has been progress in some areas, in addition to reforms on credit information, registration, and online licensing for companies, which have reduced the cost of starting a business in Sao Paulo and Rio de Janeiro. Uh, Digital origin certificates have made the process of importing goods faster, and investments in smart electricity grids have improved reliability in Sao Paulo. But Brazil's rise in the doing business rankings could have been even faster if not for other countries' own improvements in reducing inefficiencies. Of course, improving the business environment should be a goal in itself. Ranking positions are a consequence of a country's relative situation with respect to indicators monitored by the Doing Business report, while the absolute level of inefficiency is what affects a country's productivity. Continued commitment to a reform agenda would further improve Brazil's business environment. Regardless of its ranking in Doing Business reports, productivity and economic growth would be the greatest beneficiaries. And there is also something quite important to reckon, which is the following. The factors that limit competition in domestic markets, such as lack of logistics infrastructure, as we mentioned, differentiated state tax regimes, subsidies to specific firms, etc., make the rate of survival and resource retention in less efficient companies higher in Brazil than in other countries, with the price paid in terms of lower average productivity. Such retention of resource in inefficient use is illustrated in this chart, which shows the distribution of firms' managerial quality in Brazil compared, for instance, to the United States, and shows the existence of a higher proportion of firms below the average, which means that the figures in terms of average productivity are worse than what would be the case if there were more competition eliminating misallocation of resource. So policies to support the private sector need to shift from compensation for high internal costs to strengthening the adoption and diffusion of technologies. Other dimension of the Brazilian business environment would obviously be the trade across the border chapter, which we have already approached in our previous video. But now let's look at the public sector obesity. As I have remarked, this public sector obesity has aggravated the productivity anemia through the lack of investments, public investments in infrastructure. But obviously, it is also aggravated by the productivity anemia. Because while productivity and GDP growth potential have maintained their anemic increase, annual current public spending has risen sharply in real terms over the past decades. 68% between 2006 and 2017, remaining since then below the constitutionally mandated spending cap prevailing since its approval in 2017, except for the emergency expenditures during the 2020 coronavirus crisis period. With tax revenues reflecting the decline in GDP in 2015 2016 and the subsequent fragile macroeconomic recovery, a deterioration of the primary balance by more than 4 percentage points of GDP sent public debt on an explosive trajectory, rising from 54% to 74% of GDP between 2012 and 2017. Not surprisingly, fiscal adjustment became a basic tenet of macroeconomic policies seen as essential for Brazil. In 2016, the constitutional amendment establishing a spending ceiling was approved by Congress. And then that was expected to allow a return to a fiscal and sustainable debt trajectory in 10 years, with a path of gradual improvement in the primary balance equivalent to 0.5 percentage points of GDP per year. That was, of course, before the extraordinary public spending hike in 2020 during the coronavirus crisis. Now, it's important to highlight that the spending cap has to be followed by a series of structural reforms. There is no hope for recovery of primary balance by pure and simple tax collection, given the levels achieved by the public spending and the automatic expansion mechanisms in place and the potential pace of GDP growth. You cannot avoid reshaping the profile of public spending. Attempts to revitalize the economy via increase in public spending, not backed by some credible fiscal adjustment plan, would not be able to convince private players that growth might be sustainable. Z. Expenditures on Social Security, the public sector payroll, and subsidies and tax exemptions are areas where one may find opportunities to reduce current public expenditures while minimizing impacts on the bottom layers of the income pyramid and creating space for other types of public expenditure. And that will depend on structural reforms, curbing the evolution of mandatory federal expenditures depicted in the chart. A pension reform was approved in 2019, but the other components have not been significantly touched. If that doesn't happen, the spending cap may cease to be feasible as the space for discretionary expenditures on education, health, infrastructure, security, and else would disappear. And see, while the public spending rose dramatically in the last decades, as I observed, the issue of a public sector obesity shows up in the accompanying public spending on investment. See, while the as a proportion of GDP, public expenditures rose from less than 30% in the 80s to about 40% in 2017, public investment declined, partly explaining the precariousness of infrastructure that we discussed earlier. And this looks like a symptom of how rising public spending, although partially reflecting a search to mitigate dire features of inequality that accompanied Brazil's development in its history, has not been healthy from an economic growth standpoint. And well, as we have already mentioned, a major factor underlying the low productivity increase in Brazil, the productivity anemia, is the quality of education and the formation of human capital. This could benefit from less rigid allocation of public resource and the dissemination of successful experience from states and municipalities. A state reform would certainly will be welcome. The mismatch between the limited growth potential that results from the productivity anemia and, on the other hand, growing public spending, reflecting a desire for state responsibility in multiple social functions, is aggravated by clear inefficiency in the provision of several services, comprising the phenomenon of public sector obesity. As to the source of such inefficiency, this World Bank report pointed out to an excessive number of rules and budget rigidity, fragmentation of service delivery, poor planning, monitoring, and evaluation of projects and policies, human resource management without positive performance incentives, judicialization of policy decisions, and growing risk aversion in the bureaucracy. And these points, highlighted by the bank, are illustrated by the evolution of both the earmarked revenues in the chart and the results attained by public spending. This is a comparator of, on the one hand, you can see the high levels of general government expenditures as share of GDP. On the other hand, you compare that with the indicators of results, quality of results for in health, in public security, and as well overall infrastructure, as well as education. So in each of these areas, greater consistency between planning and execution, emphasis on evaluation, and greater fine-tuning between public and private sectors would lead to better socioeconomic results per unit of public expenditure. The application of a gradual but steady treatment while protecting the poor and the young is the best procedure to cure the public sector obesity that has afflicted the Brazilian economy. And the 2020 coronavirus crisis has brought new issues, but we leave that to our our next video. So, in a nutshell, the Brazilian economy has been suffering from the combination of low productivity increase, at least until recently, a growing public sector that has not delivered positive results on that front. The country needs to invest more and better in infrastructure, keep reforming its business environment, and improve the quality of public intervention. You will find a discussion on Brazil's double disease in chapter 21 of my book that you can find on those places on the slide. In the next video, we turn to the pandemic and the global economy. Later on, we will approach the post-pandemic challenge faced by Brazil and non-advanced economies more broadly. Stay tuned.